Welcome to the Deep Dive, where we get straight to the critical pivot points in the market. Today, we're dissecting the Q1 FY2026 earnings from Ferguson.
Yeah, the specialized distributor focused on, the circulatory system of modern buildings, water and air infrastructure.
We heard the call pre-market on December 9th, and the results presented a striking divergence.
Oh, absolutely. Management was confident, they delivered margin expansion, and they even raised their full-year guidance.
And yet, the market reacted with swift, brutal selling pressure.
Exactly.
So that's our mission today, to understand this paradox. How does a company with solid top-line execution get punished so severely?
Was this just impossible expectations, or is there a genuine near-term risk buried in the numbers?
Our initial take is that the execution was strong, but that expectation bar for profit was set way too high.
That high bar led directly to the sell-off. So let's start with the financial headlines that framed the day. Revenue came in at a robust $8.2 billion.
Which was a 5.1% increase year over year.
Right, and supported by 4.2% organic growth. That was a beat against consensus estimates.
The market didn't focus on the revenue, though. It focused on the miss on the bottom line. Adjusted EPS landed at $2.84, which fell about 13 cents short of that consensus high-water mark of around $2.97.
And that seemingly small gap just triggered an immediate reaction.
But that's where the paradox truly begins, because if you look at their operational discipline, the quarter was fantastic.
It really was. Gross margin expanded by a significant 60 basis points, landing at 30.7%.
And the adjusted operating margin.
Even more impressive, it hit 9.9%, which is an 80 basis point improvement over last year. I mean, they showed serious control over their cost base.
Okay, so we have strong sales growth, material margin expansion, but this minor EPS miss results in the stock plunging roughly 7.7% on the day.
The market was clearly not buying the overall narrative.
We need to know what powered the revenue and what caused that drag on profit expectations.
The power source was undeniably the U.S. segment. It delivered 5.3% net sales growth. And the crucial takeaway from CEO Kevin Murphy was that this strength relied almost entirely on the non-residential sector,
which posted another quarter of double-digit growth.
Yeah.
Non-residential really is the engine right now. Two sectors stood out as clear winners. First, waterworks.
Revenue there grew 14%, fueled by large municipal projects, public works spending. Think buried infrastructure, piping, critical water systems.
That's a fundamentally stable growth area.
It is, but the true star, and where the forward-looking strategy lies, was commercial mechanical. It surged 21%.
And they attributed this phenomenal growth to large capital projects, specifically the unprecedented boom in data center construction.
The quantification of this exposure is so critical for anyone analyzing Ferguson. Management estimated that these large projects, hospitals, manufacturing, and data centers, are now a mid to high single-digit percentage of total company revenue.
And here's the nugget.
Yeah, data centers alone make up over 50% of that rapidly expanding capital project portion. They're clearly executing into a massive, multi-year technological tailwind.
That execution in non-res was crucial because they are navigating some serious cyclical headwinds in other historically larger parts of their business.
Definitely.
Let's unpack those headwinds, starting with the consumer-facing side. Residential markets, which still represent about half of U.S. revenue, they remain challenged.
Very challenged. Residential revenue declined 1%, impacted by softness in new builds, permits, and critically, RMI.
And for those less familiar, RMI stands for repair, maintenance, and improvement.
Right. This is the crucial, steady revenue that comes from homeowners fixing a broken water heater or upgrading an aging HVAC system.
And when housing slows, people postpone those large discretionary RMI projects. We saw that softness in the numbers.
You did. And the other major headwind was the HVAC segment, which is a key focus for their national expansion. That segment saw revenue decline 6%.
And that decline came against a very difficult comparable from the prior year.
A very tough comp. It was up 9% last year.
That prior year strength was driven by what's called the A2L transition pull forward.
Right. Last year, the industry was preparing for a regulatory shift to new, more energy-efficient refrigerant standards, the A2L.
So contractors and customers bought up all the older, cheaper equipment before the new standards hit.
Exactly. Artificially boosting last year's sales. And this year, they're paying the price for that pull-forward effect.
On top of that, management cited equipment price increases and a cost-conscious consumer deciding to, repair versus replace that aging unit.
Even up north in Canada, net sales only crept up 2.2%, with adjusted operating profit falling by $7 million. It just signals subdued markets everywhere else.
So this is where we loop back to that operational excellence. Despite these volume declines in residential and HVAC, they managed to massively expand their adjusted operating margin.
By 80 basis points to 9.9%. It's incredible.
How exactly did they achieve that level of leverage while facing those major volume struggles?
It comes down to cost control and efficiency. Operating costs grew slower than revenue, resulting in 20 basis points of what they call operating leverage.
And to put that simply for you listening, they grew their sales base faster than they grew their fixed costs like salaries, rent, or utilities,
Proving their business model is increasingly scalable.
Let's talk about the pricing environment, which feeds directly into margins. Overall, inflation stepped up slightly to about 3% this quarter.
Yeah, up from 2% last quarter. But that inflation was not uniform, which is important. Finished goods, the actual fixtures and equipment, were at the high end of the low single-digit range.
But on the commodity side,
The basket was down in the low single digits overall. That was primarily driven by PVC, which is still experiencing deflation, down in the low double digits.
so that deflationary element helps drive lower input costs?
It does. But not all commodities are deflationary. Exactly. They saw mild inflation in steel and strong inflation in high-demand items like copper tube and fittings. So it's a highly nuanced environment where management clearly showed skill in sourcing and managing inventory to capture that margin expansion.
Okay, moving to capital strategy. Their balance sheet gives them huge flexibility.
It's very strong. Net debt to adjusted EBITDA sits at a conservative 1.1 times.
This strength allowed them to return $372 million to shareholders. That includes $208 million in buybacks and raising the dividend by 7% to $0.89 per share.
And they were also actively expanding their footprint, having just completed the More Supply HVAC acquisition in Chicago.
All this confidence culminated in raised guidance.
Right. Despite acknowledging the near-term headwinds, those challenges we just discussed, management tightened the net sales growth forecast to about 5% for the calendar year.
And raised the low end of their adjusted operating margin target to a new range of 9.4% to 9.6%.
This is where the market narrative completely breaks down, right?
It makes no sense. If execution is strong, margins are expanding, and guidance is raised, why the aggressive 7.7% sell-off?
The fear was centered entirely on near-term velocity. That's precisely it.
The Q4 forecast.
Yes. Management is only guiding to approximately 3% growth in the calendar fourth quarter, so the current quarter. That's driven by that continued weakness in new residential and HVAC.
And that rapid deceleration from the 5.1% they just reported, it created panic. Investors saw 3% and thought, the high-growth story is broken.
And that brings us back to the heart of the valuation problem. This stock was priced for absolute perfection.
It had delivered a massive total shareholder return over the last few years, up over 40% year-to-date, 120% over 3 years.
And it was trading at a premium mid-20s PE multiple. When you're trading at that kind of premium, any deviation, even a small EPS miss, coupled with a forecast showing growth slowing that dramatically to 3%.
It triggers a severe valuation reset.
The market interpreted the Q4 slowdown not as a cycle, but as a break in the structural thesis.
But hold on a second. If 50% of your crucial large project segment is currently data centers, aren't you just replacing one cyclical risk housing RMI with another one?
You mean the inherently volatile CapEx cycle of hyperscalers?
Exactly. That infrastructure money doesn't flow smoothly. It flows in massive, lumpy phases.
That is the essential risk, and it's why management dedicated so much time to reinforcing their long-term strategy. They're proactively shifting the company from a traditional, purely cyclical distributor
into a high-quality, specialized infrastructure and project partner. The idea is to capture margin by offering value beyond just the product.
Yes.
So how are they executing that strategic transformation? We need more detail on what these investments actually mean for the contractor on the ground.
Well, the investments are all designed to solve contractor pain points. For example, they're converting 650 of their counters to a more service-focused, efficient model. They're adding 250 to 300 trainees to deepen their local product knowledge, which is vital when a contractor needs specialized advice on a complex project.
And what about the digital side and those value-added services?
That's where they justify the premium pricing. They leverage digital tools to manage complex orders, and they offer sophisticated services like fabrication and virtual design.
Okay, so for the contractor, this means Ferguson takes on the complex, time-consuming task of cutting pipe, bending copper, or assembling components off-site.
Right. The contractor receives a prefabricated system ready to install, which drastically simplifies the on-site job, saving them significant time and labor cost.
It makes them stickier. If they can streamline the contractor's process, that customer is much less likely to jump to a competitor offering a slightly lower price.
Exactly. They are moving away from being a commodity box pusher to being a partner in complex infrastructure execution.
And your point on lumpiness.
Management acknowledged it. They said large capital projects have long gestation periods and are inherently volatile. However, they mitigated that risk by confirming that open order volume for these large projects continues to grow.
So that suggests a robust and sustained pipeline that buffers against individual project delays.
It does. They are playing the long game for margin and market share.
Before we wrap, let's pivot to the segment everyone waits for, the "This is not financial advice" segment.
We are simply analyzing market mechanics and discussing plausible reactions to the sharp market movement we observed.
Given the dramatic divergence, strong operational execution coupled with a severe price punishment, we see a classic technical mispricing opportunity here.
I agree. The fear embedded in that Q4 forecast has, I think, overshadowed the long-term fundamentals.
So what's the trade idea that capitalizes on this specific volatility?
We're pitching a short-term tactical long position, ideally structured as a calendar spread. The core premise is that the market dramatically overreacted to that anticipated calendar Q4 slowdown.
So this tactical position is betting on the timing of the valuation correction, not necessarily the long-term direction.
Which already looks fundamentally sound.
Yeah, walk us through the mechanics of that spread, simply.
Essentially, you are selling the near-term fear, the volatility caused by the 3% Q4 guidance, and you're buying the long-term conviction based on their strategic shift to specialized infrastructure.
You're betting that the panic selling of December 9th was just a short-term anomaly.
Precisely. The long-term catalysts that sustained differentiated growth in data centers and waterworks, plus the proven margin discipline that lets them guide to 9.4% to 9.6% operating margins, that will eventually re-rate the stock.
So you buy the dip using the calendar spread to manage the short-term exposure, and you're banking on the stock recapturing that roughly $18.99 loss from that selling spree.
The entry point is now, and the payoff hinges on EPS reacceleration in the next 2 quarters as that tough HVAC comparable normalizes. It's a bet on strategic patience being rewarded over reactive panic.
So what does this all mean for you, the well-informed learner? Ferguson delivered strong margin expansion and double-digit non-residential growth, proving the execution discipline is high.
But the near-term headwinds in residential and HVAC volume deceleration mean investors, they must be patient.
The strategic story is clear. They are mid-journey and transforming into a high-quality water and air specialist, focused on margin-rich, complex projects.
And they're performing admirably in a tough environment.
Which raises an important question you should keep mulling over. If Ferguson management can successfully maintain mid-single-digit sales growth and high 9% margins, while 2 of their key segments, residential and HVAC, are experiencing substantial cyclical headwinds, what happens to their strategic positioning and ultimately their premium valuation when the housing market finally stabilizes or rebounds?
That potential future tailwind is why this execution paradox is so critical to understand. The foundation is set, but the macro has to cooperate to unlock that next leg of growth.
A truly fascinating divergence. Thank you for joining us for this deep dive.
Thanks for listening.
We'll catch you on the next call.